Newly released data has just validated what we've been monitoring for months. The United States Mint has officially halted online sales of silver numismatic products. The Royal Canadian Mint, one of the most advanced minting operations on Earth, has listed its premier silver maple leaf as unavailable across major distribution channels. Two sovereign government mints, representing two of the largest economies in the Western Hemisphere, are simultaneously incapable of providing physical silver to their own citizens. This isn't conjecture. This isn't hearsay. This is documented, verifiable information from official government sources acknowledging they cannot satisfy physical silver demand at prevailing market prices. Before we dig into the data, let me be perfectly transparent about something important. I will never request your money. No paid signals, no programs, no mentorship offerings, no investment schemes, no subscription services, no premium content locked behind paywalls. If anyone leveraging my name or channel identity tries to sell you anything, report it immediately. That's a fraudulent operation attempting to exploit the trust this community has established. I produce this content because verified information matters during financial conflict. This is education, not financial counsel. Safeguard your capital. Independently verify every single assertion I make through primary sources. Avoid anyone promising effortless profits in this market, because such promises invariably come from people seeking to take your money, not help you grow it. Now, let me detail precisely what's happening with these mint suspensions, because the ramifications are far graver than most people grasp when they glimpse a headline and keep scrolling. The U.S. Mint's suspension announcement cited repricing as the official justification for pausing sales. They claim extreme market turbulence has compelled them to temporarily cease operations to recalculate their pricing framework for silver products. But here's what the official explanation actually reveals when you decode the bureaucratic phrasing. The United States Mint cannot acquire raw silver blanks at prices that permit them to sell completed American silver eagles without absorbing a meaningful loss on every coin manufactured. Sit with that for a moment. The sovereign mint of the world's reserve currency issuer, the most formidable economy on the planet, is conceding through its actions that it cannot profitably manufacture silver coins at current spot prices. This is what market analysts term a force majeure event in the retail silver market. When I reference force majeure, I mean circumstances outside normal operational control that obstruct contract fulfillment. These aren't minor supply chain disruptions that sort themselves out within days. Leading U.S. dealers, including APMEX, JM Bullion, SD Bullion, and others, have been compelled to list pre-sale dates for 2026 American Silver Eagles, with delivery timelines extending weeks or even months ahead. The physical premium needed to obtain actual metal has entirely detached from the spot price shown on trading screens. You are now operating in a split market where the screen displays one price while the real world demands something altogether different. Here are the precise figures as of this recording, which you can confirm yourself. International spot is trading between $70 and $76 per ounce, depending on which market and contract month you reference. Western spot sits at roughly $73.50 on COMEX futures. Shanghai physical silver is trading at $120 to $130 per ounce. Calculate that gap with me. That's a $50 premium, approximately 50 to 60% above New York pricing for the identical metal, the identical purity, the identical weight. The sole difference is location and the readiness of Eastern purchasers to pay the true market clearing price rather than the synthetic paper price. The figure on your trading screen is progressively becoming fiction. The real price is what you actually spend to secure physical metal delivered into your hands. That's the price that counts when the music stops and everyone scrambles for a seat, only to discover there aren't enough chairs. The Royal Canadian Mint situation confirms this scarcity isn't confined to American operations or American supply networks. The RCM is broadly regarded as one of the most advanced and prolific minting facilities worldwide. They possess state-of-the-art technology, enormous production capacity, and expertise refined over decades. They supply bullion dealers throughout North America, Europe, and Asia. And their flagship 1 Oz silver maple leaf, among the most recognized and trusted silver coins globally, is marked as sold out on their own official platform and across major distributor networks simultaneously. This isn't a fleeting demand surge that will resolve next week when a shipment comes in. Prior to this stockout, silver had reached a record price of $129.82 Canadian in the domestic Canadian market. The subsequent price retreat to current levels, which some analysts labeled a healthy correction, has utterly failed to replenish inventory. That's a vital data point to absorb. Lower prices did not coax inventory back into the market. The casual holders have already exited their positions. What remains in the physical market are holders who treat silver as protection against systemic risk, not as a trading vehicle. They will not liquidate on every 10% dip. Let me tie this directly to the COMEX data, because the vault situation is where the arithmetic becomes thoroughly undeniable for anyone prepared to consult primary sources. COMEX registered silver, the metal officially designated and available for delivery against futures contracts, has formally dropped below the 100 million ounce mark. Current registered inventory rests at approximately 98.1 million ounces, according to the latest warehouse stock report. Open interest for the March 2026 contract represents roughly 429 million ounces of paper claims against that stockpile. Do that calculation with me. 429 million ounces of paper claims versus 98.1 million ounces of registered metal available for delivery. That yields a coverage ratio of approximately 4.4 to 1. 4 paper claims exist for every single ounce of deliverable silver sitting in those vaults. But here's where the picture deteriorates further. At the current withdrawal pace of roughly 785,000 ounces departing COMEX vaults daily, by the time first notice day arrives on February 27th, registered inventory could fall to 85 million ounces, or potentially even less, should withdrawal rates intensify. February 27th is precisely 9 days from today. That is the countdown that matters right now. That is the date circled on the calendar of every institutional trader who comprehends how futures delivery mechanics truly operate. First notice day is when holders of futures contracts must formally declare whether they want cash settlement or physical delivery of the metal backing their contracts. If merely 20 to 25% of contract holders insist on receiving their physical silver rather than accepting cash settlement, the exchange mathematically cannot honor those delivery requests with existing registered inventory. This isn't fear-mongering. This isn't conspiracy thinking. This is elementary arithmetic verifiable through publicly accessible COMEX data. The question then becomes, what transpires when a major commodity exchange cannot deliver the physical commodity underpinning its paper contracts? History supplies the answer through multiple precedents. The exchange invokes force majeure and resolves contracts in cash at whatever price the exchange deems fair value. Contract holders who desired and anticipated actual metal receive paper currency instead, at a price set by the very institutions that couldn't deliver. The paper price and physical price formally separate from one another. This is the scenario materializing in real time, before anyone attentive to primary source data. While this physical insolvency crisis intensifies in Western vaults, consider what the major bullion banks have been doing with their own positioning over recent years. JP Morgan, which maintained the world's largest concentrated short position in silver for over a decade, has entirely reversed its book to the long side. They now reportedly hold between 713 million and 750 million ounces of physical silver in their own vault facilities. Absorb that figure and its magnitude, 750 million ounces. That single institution's physical holdings represent roughly 7.5 times the total COMEX registered inventory that supposedly backstops the global futures market. Simultaneously, while building this enormous physical position, exchanges have raised margin requirements to approximately 15%, demanding roughly $25,000 per contract to sustain positions. This margin hike sparked a selling cascade that wiped out retail traders and smaller speculators unable to meet the heightened capital demands. The institutions that increased margin requirements then absorbed those liquidated positions at discounted prices. The mechanics of this wealth redistribution aren't concealed. They're recorded in exchange filings and bank reports accessible to anyone who seeks them. Now let me share data that mainstream financial media is purposefully not covering with proper urgency, because it clashes with reassuring narratives. On February 2nd, 2026, the United States government formally launched Project Vault, a $12 billion strategic reserve initiative targeting 60 critical minerals vital to national security and industrial self-sufficiency. Silver is explicitly included in this critical mineral classification. The United States government is now directly competing with private investors, retail purchasers, and industrial consumers to lock down physical metal supply chains. This policy transformation permanently alters the fundamental market structure. When the federal government classifies a commodity as strategically essential and commits billions in taxpayer funds to secure supply, they aren't making a short-term speculative move or reacting to fleeting market conditions. They are bracing for a world where that commodity becomes scarce enough to jeopardize national security and domestic industrial output. Defense systems, semiconductor fabrication, solar panel manufacturing, AI data center infrastructure, medical devices, water purification systems, all demand silver in volumes that current worldwide mining output simply cannot fulfill. The government has already begun executing contracts directly with major mining firms to secure production before it reaches the open market. BHP recently completed a $4.3 billion silver streaming agreement that reserves their output for designated buyers. This kind of deal structure means retail investors and smaller industrial users increasingly find themselves at the back of an ever-lengthening queue, vying for whatever remains after governments and major corporations have claimed their share. Let me address the industrial demand figures specifically, because these aren't speculative forecasts or hypothetical models. These are documented consumption patterns already playing out in the physical economy. Solar photovoltaics now account for approximately 29% of total silver industrial consumption annually. That proportion has nearly tripled since 2014 and keeps accelerating. The global energy transition isn't discretionary according to government mandates across Europe, North America, and Asia. The European Union alone targets 700 gigawatts of solar capacity by 2030, demanding hundreds of millions of additional silver ounces that don't presently exist in accessible supply. The shift to next-generation solar cells, specifically TOPCon and HJT technologies, requires substantially more silver paste per panel than the older PERC technology that dominated earlier installations. Manufacturers cannot swap in copper or aluminum without compromising the efficiency and longevity that make their products viable. They are what economists classify as price inelastic purchasers. They'll pay whatever the market commands because their entire business model hinges on silver availability irrespective of cost. AI infrastructure demand is surfacing as an additional consumption force that most market analysts haven't yet factored into their projections. AI data centers need extensive physical infrastructure, high-performance connectors, switches, thermal management systems, and server components. Every one of these applications depends on silver's unmatched electrical and thermal conductivity, which can't be duplicated with less expensive alternatives without sacrificing performance. Since 2000, worldwide IT power capacity has expanded by over 5,000%. That exponential growth trajectory correlates directly with rising silver consumption in electronics production. Here's a specific figure linking AI infrastructure to an even more striking silver consumption pattern. Tech titans, including Microsoft and NVIDIA, are actively constructing small modular nuclear reactors to independently power their data centers, reducing reliance on increasingly strained electrical grids. Each small modular reactor requires roughly 56,000 ounces of silver for its control rod assemblies, which employ silver-indium-cadmium alloys composed of 80% silver by weight. These control rods are indispensable safety components that avert reactor meltdowns. No substitute material offers comparable neutron absorption properties. These technology firms hold trillions of dollars in cash on their balance sheets, spending $200 or $300 per ounce for silver amounts, to a rounding error beside the trillion-dollar scale of their AI infrastructure commitments. They will meet any price the market sets, because the alternative is watching their competitive standing erode while rivals secure supply. The Shanghai Futures Exchange provided further independent validation of global market strain this week through official policy declarations. They announced that beginning at the end of February, participants lacking specific hedging quotas receive zero-lot delivery allocation on all silver contracts. Zero allocation, not diminished allocation. Zero. This is formal exchange policy from a major worldwide trading venue, openly acknowledging that physical supply cannot sustain delivery demands from speculative participants. Additionally, SHFE suspended 6 account clusters this week for coordinated short selling intended to manufacture artificial downward price pressure. These enforcement measures are documented in official exchange filings accessible to market participants. When you observe multiple major exchanges concurrently enacting delivery restrictions while probing price manipulation, that isn't coincidental timing. That's coordinated recognition across regulatory bodies that the paper pricing framework is fracturing under physical market strain. Let me present the bearish perspective with intellectual candor, because you need both sides of this analysis to make sound decisions about your own capital deployment. The nomination of Kevin Warsh as Federal Reserve Chair triggered a substantial repricing of interest rate expectations across all asset classes. Warsh is recognized as a hard money advocate who has historically opposed quantitative easing and accommodative monetary policy throughout his career. His nomination was read by markets as an indication that the incoming administration will accept short-term economic discomfort and asset price deflation to confront lingering inflation concerns. Real yields surged following the announcement, rendering non-yielding assets like silver and gold less appealing relative to Treasury bonds, now offering meaningful positive returns above inflation. The dollar rallied meaningfully, generating resistance for all dollar-denominated commodities, because international buyers must convert more of their domestic currency to acquire dollar-priced assets. The FOMC minutes releasing today could reinforce hawkish sentiment that keeps paper prices muted in the short term. If the minutes disclose unified committee determination to hold rates at 3.50 to 3.75% through April with no imminent reductions planned, algorithmic trading systems will dump silver on that policy affirmation. This constitutes genuine near-term risk that could drive prices toward the $72.80 technical support level, or potentially lower toward $68.80 if selling gathers pace. However, and this is the essential analytical distinction, the bearish thesis rests entirely on one foundational premise. It presumes paper markets retain indefinite authority over physical price discovery. And that premise is exactly what the mint suspensions, the vault depletion, the delivery constraints, the Shanghai premiums, and the government stockpiling programs are exposing as progressively illusory. The mathematics don't balance. The U.S. government cannot simultaneously execute Project Vault stockpiling while paper prices linger at current depressed levels. Industrial consumers cannot erect factories and data centers without obtaining physical supply, regardless of what the paper price indicates. Mining companies cannot expand output to match demand because roughly 70% of worldwide silver production emerges as a byproduct of zinc, copper, and lead mining. You can't simply elect to mine more silver. You only extract more silver if you choose to mine more base metals. And base metal output responds to base metal economics, not silver pricing. We are witnessing a structural failure of the Western pricing mechanism for silver unfolding in real time. The paper market is generating one figure on screens. The physical market is requiring an entirely different figure at the point of actual exchange. The Shanghai premium of $50 or greater conclusively demonstrates that Eastern buyers will pay substantially above Western spot prices to obtain actual metal for delivery. That arbitrage window shouldn't persist in an efficient, properly operating market. Its continuation and expansion confirm the market isn't operating according to its official framework and stated procedures. Here is precisely what you should monitor over the coming 9 days as events progress. Track COMEX registered inventory daily. The data is publicly reported and independently confirmable through multiple sources. Follow March contract open interest as we near first notice day on February 27th. Observe whether contract holders opt to roll positions forward to subsequent delivery months or whether they insist on physical delivery. Watch the Shanghai Premium daily to assess whether the gap between Eastern and Western pricing widens or contracts. Pay particular attention to any further mint suspension declarations from other sovereign facilities worldwide. The Perth Mint in Australia, the Austrian Mint, Mexico's Casa de Moneda, the South African Mint. If any of these operations announce supply limitations or sales halts in the days and weeks ahead, that definitively confirms the physical deficit is worldwide in scope, not limited to North American supply chains. Every piece of data I've laid out in this analysis is publicly accessible from official primary sources. COMEX warehouse reports are dated and reachable through exchange websites. Exchange policy modifications are recorded in official filings and press statements. Mint suspension announcements originate directly from government agencies. Shanghai pricing is monitored daily across multiple financial platforms. Don't accept my word for any of this. Retrieve the actual reports yourself. Verify the actual figures through primary sources. Cross-check claims against official records. The market participants who perform that due diligence, who confirm assertions independently through primary sources, who cross-reference data against official documentation, they comprehend why 9 days matters. They understand what 4.4 to 1 coverage ratios signify when delivery pressure mounts. They understand why two major sovereign mints simultaneously cannot furnish their own populations with silver coins, despite running sophisticated production operations. The market participants waiting for financial television to frame the situation in palatable terms that don't disturb their prevailing beliefs about how financial markets operate. They'll be scrambling to acquire physical silver at considerably steeper prices months from now, puzzled why nobody alerted them to what was developing in plain view. The warning is preserved in official sources. The data is public and confirmable. The primary sources are available to anyone willing to examine them. The question is whether you're the kind of market participant who verifies information independently, or the kind who dismisses inconvenient data without scrutiny because it challenges comfortable assumptions. 9 days until first notice day. 98 million ounces in registered vaults against 429 million ounces of paper claims. 2 sovereign mints unable to deliver physical metal to retail buyers. A $50 premium dividing Eastern physical prices from Western paper prices. Government stockpiling initiatives competing with private purchasers for available supply. Verify everything I've presented. Invest guided by logic rather than emotion. Shield your capital against both upside and downside possibilities. This is financial warfare education.